All right, you should be able to see my screen now, I think, at least. All right. Anyways, welcome. Thank you guys for joining. I know it's just us two, us three, I guess, us four now. But regardless, we're going to be talking about financial markets for the most part of the lesson, and then we're going to be diving into what exactly the quants do and see if that's an interesting field for anyone in the last few slides. So without further ado, I'm not trying to waste your time. Let's just go ahead and jump right into it. So the big idea, sorry about that. The big idea, basically financial markets move money from point A to point B. So there are people who have money who want to save or invest the money. And there are companies and governments that need the money to do things productively. And the market basically connects these two people. So, for example, let's say a company needs some money to build factories, hire people, whatever it may need. Investors have the money, so they give the money to the company in exchange, want to make money on that investment. So at the simplest level, financial markets help move money from people who have it to people who can actually use it for productive reasons for the company, and the people who give the money out hopefully want something new. I want return on that money. A common market is a stock exchange. A very common stock exchange could be like the NASDAQ or the New York Stock Exchange, where stocks are held publicly. Okay? So there are two types of markets that are pretty important to understand. The first market is called the primary market. And the primary market is where a security is being sold for the first time. So imagine a company goes public through something called an IPO, an initial public offering. It's when a company goes from private to public and it sells shares. Investors give the money to the company and the company gives investors shares. So in a primary market, I am giving the company money. The company is selling me shares and I'm buying the shares and I'm buying the shares from the company, which means I'm giving the company money. That's the primary market. The next thing after a primary market, which you probably can tell from the slide, is a secondary market. In the secondary market, I don't give the company any money. When I buy a share, I am buying it from someone who is selling it, another investor. Secondary markets are the most common market because a secondary market is anything after a primary market. So in a secondary market, when I'm buying a share, which is what most of us are going to be doing, another investor has to sell me that share as well. That's the key idea. Primary market, they're giving money to the company, and a secondary market, they're giving money to the investor. And the same goes for selling as well. Now let's look at the bid and ask. So if you want to buy a stock, there is not just one set price. There is usually two prices. One of the prices is called the bid, and the bid is what buyers are willing to pay. And the ask is what sellers are willing to accept. So maybe the highest buyer is, $99.98, while the lowest seller is $100. That little difference between the bid, and the ask is called the spread. So usually very heavily traded stocks have very small spreads because there's so many traders in it. People are going to be bidding higher and asking for cheaper because they want to get rid of their orders. It's just more competitive that way. But however, less traded investments usually have higher spreads because there's just not enough activity to have higher spreads. So that's the difference between the bid and the ask. And whatever order you get filled at usually might be closer to one of these two depending on if you're buying or selling. So let's take a look at who's involved. So there is a bunch of participants in financial markets. I mean, a lot. I'm going to give some examples, but be warned, this is a very small list of examples. So obviously, you probably heard of individual investors or retail investors. These are people like me, you, and everyone else in the workshop. The people who are just regular people managing the money, maybe their family's account, their retirement account, whatever it may be. Then you have companies. Now, companies are obviously involved in markets. They're the people who are actually selling the shares or publicly traded on the company. And the government do the same thing through something called bonds, which we'll talk about later in the slideshow. Now, banks are involved, funds and pensions are involved, people who actually manage money are involved, and traders and market makers are also involved as well. There isn't one type of investor. There's a bunch of people playing in the markets, and it's pretty important to understand because different people have different motives for why they're investing in the market. For example, a retail investor just wants to maybe retire nicely with a nice 401k or something like that, while a hedge fund wants to make a bunch of money, beat the market. And a market maker is actually doing something completely different, making the bid and ask spread smaller. And then the last thing is a regulator. Now, if you look at this bottom left image here, a regulator is A regulator is someone who regulates the market, the people who enforce rules. They don't actually participate in the markets, they just oversee everything. In the US, it's called the Securities and Exchange Commission. It was born out of the US Great Depression to rebuild investor trust. They rebuild investor trust by ensuring that anyone who inside trades, market manipulates, anything illegal regarding publicly traded stocks or securities are going to be prosecuted and whatever that punishment might be. It helps rebuild trust and also enforce the rules in financial markets. So, how does a trade actually happen? You don't technically directly talk with an investor who's selling you something if you're buying something. You actually talk to a broker, and a broker is basically a middleman. So you place an order, and then the brokerage sends the order out to the exchange, and the exchange finds someone willing to sell you the other side, and then eventually the trade is settled. Market makers are extremely important here because they constantly offer prices at which they're willing to buy and sell different things. Market makers are a bit different than funds and other things like that because they're the people who are actually providing the bid and ask, people who are providing a bunch of buy and selling orders to help fill your order. And this term is called liquidity. Liquidity just means how easy is it to sell something? How easy is it to buy something? A liquid market is basically a market where it's very easy to buy or sell something without moving the price too much. For example, Apple is extremely liquid. It's a trillion-dollar company and it has a bunch of people trading on it. So if you want to sell a share on Apple, finding a buyer is not going to be that difficult because it's so liquid. So many people are involved in trading it. Market makers are involved in Apple. That's the key idea. So in sum for this slide, whenever you place an order, you place it through a brokerage. And the brokerage basically is a middleman, and that's that. Now, let's look at some different assets. So we talked a little bit about some of these. Mostly, we haven't gotten too much into them, but there's a bunch of different assets. There's stocks, bonds, cash, real estate, commodities, currencies, crypto, and probably a lot more. A commodity could be something like oil, gold, or wheat. Currencies are like dollars, euros, pounds, whatever it might be. And all these assets behave differently. Some might offer high potential returns, lots of returns, but in exchange offer a lot more risk, and others might be more stable, offer lower returns in exchange for lesser risk. So you have to be careful between choosing which asset you want, depending on how much risk you want, how much upside do you want, how much money do you want to make, regarding the risk you have. So for example, for a retirement fund, you probably don't want to be too risky. You want to be buying some safer options, but depending on what retirement account you have and also how old are you. Next slide. So let's look at one of these assets. We can look at stocks first. What exactly is a stock? A stock is basically a tiny piece of ownership in a company. So if you own an Apple stock, you own a very small piece of Apple. If the company becomes much more valuable, your shares also become a lot more valuable too. So that is when the stock price goes up. Because if you buy a share at $100 and the share price goes to $110, you can sell it for $110 and you just made $10. The other is through something called dividends. And dividends is where a company gives some of its profits back to its shareholders. But stocks can obviously go down too. So ownership gives you upside, but it also gives you a lot of risk. That's the key idea. So stocks, you're basically owning a piece of a company, you're buying a share of a company. When you buy a share, you're a shareholder because you actually own a piece of a company. You're now a shareholder. You hold a share. And that's that. We can look at bonds and lending now. So I talked about this in the beginning of the slide a little bit. Governments are heavily involved in bonds, but companies can be too. Bonds are pretty different. With a stock, you're an owner, but with a bond, you're a lender. Imagine the government wants to borrow $1,000 from you. You give them $1,000 and they agree to pay you interest. And when the bond reaches its maturity date, you get your original $1,000 back, assuming that they can pay for it plus interest. So if I give a government $1,000, I'm going to get paid. Whenever the bond reaches maturity, I'm going to get paid $1,000 and plus whatever interest I got from giving them the money. That's how a loan works. Companies can also issue bonds too. There are things called corporate bonds. This is that for a company instead of a government. Companies can also issue bonds just like how a government does. And bonds also have prices just like stocks. Those prices can depend on several different things like interest rates. If you guys know what the Federal Reserve is, the Fed, they're the people responsible for interest rates, the economics, anything, really anything. And how risky people think the borrower is. Because the borrower also has to pay that back the money, right? If the borrower has a low chance of paying back the money, that bond is going to default, then no one's going to be able to buy it for it because why would I give $1,000 just not to get it back? Doesn't make any sense. A lot of key factors revolving bond prices, lending, etc. Now let's look at another type of asset, which is called funds, ETFs, and indexes. So imagine you want to invest and you want to be safe. You don't want to research 50 different companies, a bunch of different companies. This is where funds can be pretty useful. A fund is basically many different investments and puts them into one product. An ETF, an exchange traded fund, might contain Apple, Microsoft, banks, energy companies, bonds, anything. An ETF is just a pool of different assets. So instead of having to buy all those different assets separately, you can just buy the ETF. And it's that and easy as that. An index fund follows some kind of index. A famous example is the S&P 500, which tracks a large group of major American companies. So instead of betting everything on one company, you can actually own a small piece of every single company without having to buy 500 different companies. You can just buy an index fund that tracks the S&P 500. And the process of buying different companies with different factors. So if one company goes up, that means one company doesn't have to go up. Different factors that influence them. That's called diversification, and it helps you reduce risk. You know, probably heard of the saying, "Don't put all your eggs in one basket." Same concept here. Instead of putting all your money in one company, you spread it out a bunch of different companies. So if one company decides to go bankrupt, for example, you don't lose everything. You just lose some of it because you own a bunch of money in other companies. And a very easy way to do that is through different ETFs and different indexes. The next concept we're going to be learning about is derivatives. So if any of you have taken calculus before, derivatives, you probably think of like a math term, but they can actually apply to markets too. This is going to be the most complicated thing we're going to cover, so don't worry about everything knowing here. It's not too important. I just thought I would go over it anyway. A derivative is basically a financial contract whose value comes from something else. That something else is the underlying asset. So a contract can be coming from a stock. You might have a contract based off an Apple stock, oil, gold, or anything else. Just a contract that relies on another stock. That's all it is. For an option is the right, but also the obligation to buy 100 contracts or sell 100 contracts at a predetermined price, which means you don't have to when you get to that price. Well, a future, you have to. You have the obligation to buy or sell 100 contracts at a predetermined date. It's pretty complicated. Just for right now, just understand if you're a beginner at all, the main thing to remember is that a derivative is a contract that's based off another asset, usually a stock. And that's that. And you can use these options for different reasons. You can use it to amplify your returns, or you can use it to hedge, reduce your risk too. I have a bunch of different use cases. The key idea is it comes from an underlying asset. The contract is based off another asset. Now we can look at what makes prices actually move. This is going to be a very important idea because there's a bunch of things that makes prices move. And the key idea is that stocks don't move because something is good or bad. They move mostly because of expectations, right? Let's say a company is expected to earn $1 billion. Now, you might think $1 billion is great, okay? And they make $1.1 billion instead, okay? Everyone expects a company to earn $1.1 billion, $1 billion, and it makes $1.1 billion, which is good. That sounds great. But investors were actually expecting $1.3 billion, right? So we're talking $1 billion range. That's a lot of money. Seems great, right? But if investors expected more, expected $1.3 billion instead of $1 billion, $1.1 billion, the stock will probably fall, right? That's why you sometimes can see headlines saying a company had record profits and the stock still dropped 10%, because if they didn't meet investor expectations, the stock is not going to go up. Markets are constantly comparing with what actually happened with what investors expected to happen. So the key idea is it doesn't matter if something is good or bad, really. It just matters if it beats or misses expectations. If the company makes more money than investors expected or makes less money than what investors expected. It's all about expectations. Now we can look about how investors actually research different companies. So you first find the business itself. What does the company actually do? What does it sell? How does it make money? Then you can look at its financial statements, the balance sheets, the assets. Looks like someone else is joining. Let me go ahead and accept them real quick. Give me one sec. Okay. Sorry. Just someone's trying to get in. All right. All right. Anyways, let's get back. They can look at their financial statements. They can look at competition. Who are the rivals? Who are they competing against? And finally, they can look at their valuation. A great they can look at their valuation. How much does the company? Oh, what the heck? Sorry. Yeah, and they can look at their valuation as well. How does the company actually make money, or like how much are they worth? There's a bunch of different things investors can do to research companies, but these are probably the four key ideas. Now we can look at how do we actually value a stock. There's a bunch of different indicators for how you value a stock, and they can all be seen by like a quick Google search. There's share price, the share price of a stock. There's the market cap or market capitalization, which is the total value investors place onto a company's equity. It's just the shares times the price, the amount of shares they have times the share price, which is how much investors think the company is worth. There's the PE ratio, which determines how much investors are willing to pay for each dollar of the company's earnings. An average PE ratio is around 20. If it's like 100 PE ratio, probably means the company has been overvalued. If it's 0 to 5, it probably means it's less valued. And finally, there are earnings reports, which is everything a company makes, does, and it gets reported every 4 times a year, so every quarter. And it shows their revenue, their expenses, their assets, liabilities, everything you want to know about a company. It's in the earnings report, and they're required to do this by the SEC, by the regulator, 4 times a year. Now, we can look at risk and portfolio management. So part of investing is trying to make money, but also part of investing is trying to cut back your risk. You don't want to have too much any downsides, right? You don't want to place all your money on one bet, which could make a lot of money, but also could lose a lot of money. And the key idea between this is diversification. As everybody said, don't put all your eggs in one basket. If you're just looking to make a return, put your money in a retirement account, just put money into different assets that move for different reasons, okay? And liquidity also matters here too, because if you want to sell something quickly, you need liquidity. You need to be able to sell something quickly by having someone to buy something quickly. So a key idea here is just make sure you're diversified, make sure you spread across different assets as well. Now we can go on to an activity. You guys can see the slide here.